Welcome, everyone. Great to see you joining us today for our online masterclass on scaling tech and services businesses. We're just waiting for a few more people to hop on, and then we'll get started with some game-changing insights on scaling tech companies. While we wait, get comfortable, drop a quick hello in the chat. Let us know where you're joining from and what company you're working with as well, if you'd like. Always great to get to know who's in the room. We've got some serious value packed into the next 45 minutes or so, including some real stories from companies like Wayflyer, Intercom, Teens, plus the funding strategies that actually work in today's market. Today we're also joined by James Corcoran, who I'll introduce to you in a second. And at the end of the session, we'll have an open Q&A, so get your questions ready. You'll also receive a handout via email with main takeaways from this session. So we'll just hold on for a few minutes until we get a few more people. If you want to tell us where you're calling in from and what company you're working for, that would be great. Thanks, Chris. Calling in from Dublin. Yeah, it's a little bit rainy here. Well, actually, it's just a little overcast here. It's not too bad. Not sure what it's like where you're in Dublin, but James, you're calling from Cork today, are you?
I am. I'm in Cork.
What's it like
Sunny in
then?
Cork today.
Sunny, nice. What's rare is wonderful, says you. We'll just give it 1 or 2 more minutes for people to perhaps join, and yeah, feel free to share with us where you're calling in from today and what business you're with, and then we'll kick things off in a minute. Okay, I think we're ready to start. I'm gonna undo the chat, and I'll enable you guys to chat later on for our Q&A. So yeah, listen again. Thank you so much, guys, for joining today. We're going to talk about scaling technology and services companies. We're going to give you some key strategies for growth. So firstly, a bit of an introduction to myself and James. So I'm the CEO of Vico Advisory. I'm a chartered accountant, chartered director. For the previous decade or so, I worked for a private equity firm based in the States, and within that organization, I acquired and managed 35 technology and services companies on a global basis that generated about 400 million of revenues and about 90 or so million of EBITDA in a range of different industries, from healthcare technology to financial technology to IT managed services and a number of other areas. Now we advise on the buying and selling of companies and also on how to scale technology and services companies. That's me. James, do you want to jump in?
Thanks, Donald. Hi, James Corcoran here, consultant at Vico Advisory. My background is in building and leading tech and services businesses, both here in Ireland and internationally. I spent many years at a company called First Derivatives and then KX, where we built a software business from scratch to up to about $100 million in annual recurring revenue. And now I focus on helping customers do similar.
Nice. Thanks, James. So the agenda for today. So look, for starters, we're going to set the scene. You know, what are we talking about here? What is a tech and services company that's scaling? How do investors perceive scaling companies? We're going to touch on a couple of Irish examples as well who've really succeeded in this scaling journey. We're going to talk about how to fund your scaling efforts. Then we're going to turn over to James, and he's going to, I suppose, talk really about his journey within First Derivatives and KX. Around how to actually scale your business from 1 to 100 million of ARR. We're going to touch on a few key strategies for growth. We're going to talk about how technology is actually impacting the ability to scale in a positive/negative way. We're going to talk about how to engage with growth equity partners to fund your scaling efforts. We're going to then touch on, I suppose, how Vico Advisory can assist you potentially on that journey, and then we're going to have a live Q&A. So all throughout this, guys, please do keep in mind that we are having a Q&A. So the best value for you guys is always in the most specific questions. So do really think about some questions for myself and James. Let's kick off. So I suppose for starters, what is a scaling technology and services company, right? So it really is usually a business that provides technology based or tech enabled type services. That's really focused on rapid, and effective growth. Um, without a proportional increase in costs, right? So that's really what we're talking about here. So, it's really the ability to scale your top line revenue, by, while not having a proportional growth in your overheads that, your cost of goods sold, shall we say. And, typically these are the traits that we see. They're very technology driven, and that can be at a different stage in their technology kind of life cycle. But, typically nowadays we see minimum kind of, SaaS-based businesses. We still see some on-prem businesses that are nicely scaling, but usually it's SaaS-based businesses that, are enabling or that are embracing the use of AI, that, and cloud-based, I suppose, storage, and that usually provides some degree of analytics as well. But they also have a strong service orientation along with their business too. They're obviously scalable by virtue of the definition. But what that means is, usually they're completing processes that are very repeatable in nature. They're growth focused, and usually quite aggressive, from a product innovation perspective, in particular. And then they have, as a result of all that, quite a significant amount of recurring revenue.
Great, and we just picked out three Irish success stories here, and we'll double click into each of them as we go through the presentation. But at a high level, Intercom is a great example, building a SaaS business model, and when people think about cloud, we'll talk a lot about cloud today. Cloud is as much a business model as it is a technology. So we're going to dive into that. Let's Get Checked. Great example of having product market fit at a very compelling moment in time, and being operationally ready to scale. And then Teens, great example of being laser focused on solving a very specific problem, doing that really, really well, and then using a go-to-market strategy of landing beachhead customers and land expand with them.
Great, thanks, James. Yeah, so I suppose, look, how do investors perceive scaling companies, right? And James just touched on it there, product market fit with regards to Teens. Um, like it's investors are really, really keen to see a proven product market fit, regardless of what stage an investor comes in to the journey, to the investment journey. And I say that because product market fit isn't just a one-time only thing. Yeah, yes, you can look, or it's important for you if you're running your own kind of technology or services business to have product market fit early days as well with your first customers. But equally as important is to have it, when you're on that Series A, even B or C kind of rounds, because that's something that I think a lot of companies that are scaling can miss. The constant need to be just razor sharp focused on, on the actual customer problem and that they're solving that, as opposed to falling in love with their product, which we see quite often. So that's one of the key points that investors will focus on. Obviously, a high growth potential, like so large TAM, and a clear strategy to actually take advantage of that significant opportunity. Scalable infrastructure. So what we mean by that is not just technology, yes, but across the board operationally as well, and having great people, like so, because there's no point. We've seen businesses where they have gone on a journey, but they haven't sufficiently invested in both their business, and their people to be able to support the growth. Repeatable go-to-market strategies. We'll touch on that a little bit later. Predictable revenues. I mentioned that a little earlier. As much SaaS-based revenue or subscriptions, in particular, is something that investors like to see. And then, yeah, just around the de-risking, in terms of, there are various types of de-risking that investors will look at. We can touch on that later as well.
Yeah, we just picked out a couple of the core metrics then to focus on as you grow. Some of these metrics are more applicable at different stages of your growth, but by far and away the most important metric is the first one here, ARR growth. And that word growth is very, very important. So the rate at which you are growing year on year, your top line revenue or your recurring revenue is more important. That growth rate is more important than the absolute level, and many times for valuation purposes. And building momentum into the business. Now, the others are, very, very important, but they're secondary to some extent to ARR. I'll just pick out a couple though. Net revenue retention is a very, very good leading indicator of customer sat and how quickly you're expanding your existing base. The CAC to LTV ratio here, cost of acquiring customer versus the long-term value of that customer, that's going to change as you
Are you
grow.
still,
And
yeah,
you want to be using go to market testing as you sort of get from one level to the next. So we'll come back to some of these core metrics and as we go through the presentation.
great. Thanks, James. We're going to touch on some Irish examples here who've really successfully scaled in the last number of years and who are continuing to scale. To be honest with you, even though they've managed to achieve a significant amount of growth over the last number of years. So, firstly, with regards to Wayflyer, how do they do it? I actually got to meet Aidan and Jack very early in their life cycle, and got to learn about them as people and what they were trying to achieve. But it became really clear to me from early doors that these guys were really razor sharp focused on the need to solve a problem, which was e-commerce companies struggle with funding, especially early days, and especially with regards to funding that spent on advertising and growing their top line. And they came up with a really clever solution, a really good innovation, whereby they actually provide technology from a data analytics perspective to enable those e-commerce companies to gain better insight on their own businesses. And they gave that technology out for free. And then in the back end, Aidan and Jack used those analytics to actually be able to make better lending decisions. Really, really clever. What they did next was, I suppose they scaled their architecture, which made a hell of a lot of sense. So within their platform, they built it in such a way that they knew that this thing was going to take off like a rocket. They iterated quite often, and kept on changing their platform. The strategic go-to-market strategy, I think, was one of the key wins for them, because within about 5 months of them starting, not only were they in Ireland, but they were in the UK, Australia, and the States, literally within about 4 or 5 months. And I remember, Aidan giving the rationale behind that, saying, well, Irish-based customers are good, but obviously in the States, the wallet is much bigger. It's easier for them to make decisions. They're more straight up with you, and they will actually pay. Whereas it can take an awful lot longer, to win business and meaningful business in a local context. They then raised a significant amount of capital very, very early in their life cycle, and use that to a good advantage in building a team, and funding their own expansion, and then subsequently, obviously, raised a significant amount of capital from grade A institutions to lend to their clients too as well. And then the final point is just they grew via partnerships. They had partnerships with the likes of Amazon, BigCommerce, WooCommerce, these massive stakeholders within their own industries, but also they spotted the opportunity of having different types of partnerships with people like Shane Lowry and Niall Horan, who were very much in vogue in their own way, and they used those to their advantage.
Great, and I'll just talk briefly about Teens. Very different business, familiar with in the cybersecurity space. There's a different offering, but you can see similar growth playbook that they've deployed. So I won't go through every single bullet point here, but just to pick out the scale first architecture, I think the way they've done this is very very well thought through. Their cost of onboarding customers, is incredibly low, and that's a really great growth driver. If you're not improving that or sort of driving that down to as close to zero as you can, both in terms of time and money and effort, your growth rate would be constrained. So speed of onboarding customers, they've done a really great job there. It's similarly to Wayflyer, early marquee clients have fueled a lot of interest in the company, and they use that to their advantage. And I just say a little bit about ecosystem partnerships. We're talking about both services and tech companies here today. Ecosystem selling is really, really necessary in today's market, I believe. And so if you're a services business, your ecosystem strategy there is likely going to revolve around technology companies that may need services partners in order to help them sell, implement, deliver their offerings to customers. On the technology side, it's kind of the inverse. You might be looking for services businesses, and equally, these days when you're selling a technology offering into an enterprise, it's got to plug into many other products and platforms that that enterprise has. So having interoperability built into your product, but also into your go-to-market playbooks allows you to sort of implement ecosystem selling effectively.
Now we're going to touch on how to successfully fund your scaling efforts, right? And again, we're not going to go through these in great detail, but on this call, because obviously this is a whole other call, a whole other masterclass in its own right. But at a high level, right? The first thing that we always say to clients that come to us is, do you have your house in order? And that can mean different things to different people. But it's really critical to be really well organized, and I can't stress that enough. So like we've seen the best of the best, we've seen the worst of the worst, and everything in between. And the better organized you can be from day one, and I know that sounds a bit painful, the better chances you have in scaling your business and getting that funds required to scale. So, what does that mean? We talked about validating your business model, your product market fit, really being really razor sharp focused on certain metrics like your revenue growth, your customer acquisition costs, long-term value of your clients, your churn rates, your retention rates. So important. And then to have a vision and roadmap around that. Equally important then with regards to, I suppose, getting your house in order, I think, is understanding who's out there and what type of investors are out there for what stage in your life cycle, and what type of returns are they looking at. Because as you can see here, there's a range of different types of investment opportunities out there, or investment partners as you grow, and seeing the world from their perspective as to what type of return, what kind of risk are they willing to take, what type of I suppose how long will they likely have their investment in there is critical. We do see businesses should fall down on that kind of on that thinking as well. And the next thing is really crafting an investment story. So look, this is something that we work an awful lot with our prospective clients with. This is understanding the market opportunity. It's being clear on what traction they have and what they don't have, and not overselling themselves, but also I suppose accurately I suppose depicting what the opportunity is, and giving a really clear idea as to the team and what they've done previously, and why they're backable. And then, this competitive moat, it's critical, I think, for, especially given how uncertain things are nowadays, you've got to be the best of the best, because, only the best really survive and thrive. And so, creating that moat from early days is critical. We assist on building financial models, and this is something that we always recommend businesses do. And it's got to be robust. It's got to stack up under significant scrutiny from prospective investors, and all the way down from income statements, balance sheets, cash flows, to unit economics, and really making it realistic. There's no, like, we can all show us a hockey stick, and that's good, but don't get me wrong, I'm all for having realistic, ambitious goals and figures in a spreadsheet, but if they don't make sense, they'll be sniffed out from a mile away. And then finally, running a tight fundraising process is equally important. So targeting people, investors appropriately, understanding who's out there, what type of checks, as I was saying earlier on, they'll write, having a tight timeline, understanding, that it does take time, and preparing pitches as well is critical, and then negotiating well. And we'll touch on that later. And then just to finally say, so when I started out on this road over, probably over a decade, 15 years ago, the landscape in Ireland was nowhere near like this, like it is now. And I think that's something for businesses nowadays who are looking to scale to really appreciate. Like when I was doing this initially, you'd have only had the likes of Act, Delta Partners, perhaps, Kernel Capital, maybe Goodbody. Like there were probably, and then obviously Enterprise Ireland, right? But really probably 5 or 6 maybe, and here we are. There's easily 20 on that list there, all of whom provide capital for specific purposes at specific times for specific needs, and look for different types of returns. Some are more focused on specific industries, so there's plenty to go around nowadays, and it's just a different world. And then finally, look, let's not overlook the importance of Enterprise Ireland here, and Scale Ireland to, not-for-profit organizations who really assist on, a range of different ways, both from, capital all the way to, I suppose, grants and also networking and information assistance and just connections as well. So, we're a firm, believer in businesses really utilizing the supports that are available, be they governmental or just not-for-profit in nature, in successfully scaling your organization.
Yeah, so I'll jump in here and talk a little bit about what it feels like to work at a rapidly scaling company. So I spent about 15 years at a company called First Derivatives. During that time, we built up a tech business within the group, branded at KX. And the journey here, I mean, I tried to distill it into a few bullet points that kind of highlight those different milestones along the road. So really, at the most basic level, it started by bootstrapping a services business, and that's relatively intuitive to do. You can employ tactics like just-in-time hiring. You win services contract and deploy people against that. We leveraged graduate talent extensively during that time, and that helps you build stronger margin into your services business. And then over time, gradually, as you sort of mature a services business, ultimately you're going to want to move from T&M, time materials based contracts with your customers to things like managed services. That gives you, better, more mature relationships with your customers. It helps you sort of mature your operational capabilities as you think about sort of the SLAs now that come with managed services that you need to meet. But also it gives you optionality in terms of how you go about delivering managed services to customers. The next thing we did after that phase was to start to build IP that we're able to recycle back into what ultimately became a technology business. So when you're building managed services, some parts of the delivery you're going to want to build tools, build frameworks and things that you can reuse across clients and across projects. We ended up doing quite a lot of that in software and finding commonalities across customers. That's where the product piece comes in, and to a certain extent you're able to use your services margin if you so desire to go and fund R&D and sort of build some of those reusable assets into bigger offerings and ultimately a product that you can go to market with. The last thing that we found when we sort of got to that stage was that quite often it makes sense to go to market with a joint product and services offering. So you don't have to split those things right down the middle and have a very hard separation. They exist in their own right, but when you bundle them together, you can often go to market with an offering that's creating more value than the sum of its parts. And it was definitely a tactic that we used extensively over many years.
Yeah, thanks, James. And so we included this example because, quite often nowadays we see people just purely focusing on technology, as in like just having product-based businesses, and fair play, and we're all for it. But at the same time, like, here's an example of a business that started off in services, bootstrapped it and really got to a really proper scale and within that world, and all the while developed technology behind the scenes. And then once they had both sides of the business humming, they were able to provide, as you said, a really good, combined mixture. And I think, look, it's something that we always try to get people to think about, when they come to us and talk to us about scaling their product-based business. We always say, is there an opportunity here for services on the back end, and can they be, if not equally, close to equally, being both much needed for your clients and also, accretive to the value of your business. So yeah, thanks, James, for sharing that. Really helpful.
No worries. Yeah, so I take this one as well, and trying to again come up with a list that you can take away that is somewhat memorable. Some key scaling strategies. I'll pull out a few here that I really like. Doubling down on product market fit, as Donald said at the start. That's not a one-time exercise. That's something that you're going to want to assess both as your offering changes. Remember, you're sort of in growth mode here. Your offering is changing at the same time as the market is changing, and you want to be able to meet the market continuously. So that is an ongoing exercise. Truly believe that. Building a scalable go-to-market engine, incredibly important. And again, it's easy to sort of get a little bit ahead of yourself sometimes. And the last thing you want to do is hire a very large sales team when for example, you might not have a pipeline to justify it, or you might not have the offering of the product market fit yet. Getting the right ratio of sales reps to sales engineers, for example, things you want to be constantly assessing. It's very common for large tech companies to have one sales engineer for every sales rep. That's not the right type of ratio when you're sort of on the way up. Usually you can have multiple sales engineers or customer facing engineers and forward deployed engineers, as they're called these days, covering many accounts. So that's something we feel quite strongly about. Yeah, investing in team and culture is just another one I'll pick out here. Incredibly important to distill, I would say, a growth mindset across the company. If you're scaling, particularly if you're scaling sort of 20, 30, 40% year on year, it may feel quite chaotic at times. Typically your processes and your operations will have to grow and evolve and scale as you're moving from level to level at that sort of rate. So it can consequently feel like, well, it maybe not chaotic, but there's constant change in the organization. And having a team that's comfortable with that and can embrace that and have growth mindset, regardless of whether they're on the front lines talking to customers or whether they're in the delivery division, very important. I touched on land and expand when I was talking about teams. This is a really important tactic. Don't ever be disheartened by sort of landing a deal that you might feel is sort of smaller than you were aspiring to with a customer. If you do a good job for them, if you solve a problem, invariably you're going to grow within that account, and that's a very successful tactic if you can sort of keep that in mind and take a medium to long term view with customers, as you should always do. That's what we'll build into strategic relationships. I'll just quickly go to point 11 here, brand and thought leadership. It used to be the case that sort of brand and thought leadership was very much at the logo level, the company level. These days, thought leadership is absolutely about the sort of the brand of the personal brand of the founder and or the senior team. And so these things are sort of inextricably linked now. The personal branding of the founding team, and the sort of the way in which people perceive the company. And so, if you're not doing it already, I definitely encourage you to think about building the personal brand of the founder and the senior team. That's all going to accrue towards the brand of the company.
Couldn't agree more there, James. Thanks for that.
Yeah, so I'm just going to now talk a little bit about how tech is impacting scaling efforts, particularly sort of in the go-to-market machinery of a company. And this applies to whether it's a service company or a tech company, whether it's cloud, SaaS tooling, or AI these days. All of these trends are making it not necessarily easier to go to market, but more scalable, right? So many tools that you're able to deploy, whether it's sort of you're managing your inbound channels, executing against your outbound marketing plays. the thing to bear in mind here is that you can quickly sort of buy relatively cheap tooling and build a huge big marketing stack that if you sort of add it all up, one, it gets expensive, and two, is quite complex to manage. The point in the middle here is all about data, and sort of the more tools you have, the more your data is spread across different tools and different platforms and different providers. So think smartly about your marketing stack, as it's called, and think very, very hard about how you manage your data. Again, in growth mode, your target segment, priorities number one, two, and three, may or may not change, over the course of 1, 2, 3 years. And you want to be thinking about how you label your data and segment your customer base and prospect base. All of those things need to be taken into consideration. But for sure, SaaS tooling, cloud, and now AI is helping you automate your, in particular, your outbound marketing programs in a way that you could never do before. The last point here is around just sort of remote work. Even sort of 5, 6, 7 years ago, go to market was about having sales reps located where the customers are, meeting them in person, delivering pitch decks, often printing out the materials on their way to the meeting. That just is not the way things work these days. So remote work is a real possibility. Having a remote team in your go to market, whether it's inside sales or another part of the go to market team, and that can be leveraged really effectively. The complementary sort of point to the last slide here, is that you've got to be compliance aware when you're building up your go-to-market stack, particularly if you're procuring tools in the cloud and SaaS tools, and using AI to automate outbound emails or whatever it might be. A lot of these tools can and should have compliance and security functionality built in by default. But never forget that the burden of responsibility from a compliance perspective, privacy and security, lies with you, the company, and that has to be thought about for today, but you also have to be thinking about it for the future. And any breach with respect to customer confidential data, for example, you don't need me to tell you, is potentially fatal for the company. So it's easier than ever to be compliant, I would say, with the sort of the tools and the functionality that they offer. But the more tools you use, and the more complicated it is to manage and govern that on a scaled basis. So something that you got to be thinking about all the time.
Right, thanks, James. So I'm just going to touch on, I suppose, what growth equity firms look for when considering their own opportunities, right? So like we touched on this earlier on, like your revenue, your recurring revenue, and your growth rates are really important. Now, at the same time, having said that, obviously venture capital firms over the previous number of years were just solely focusing on growth, and I think the point that we're making here is, yes, while it's still very important, is it the right type of growth? And is it coming in, like a lot of them are looking now at gross profit, as opposed to revenue as well, because of the fact that they don't want people selling fivers for 450, right? And growing for the sake of growing. And I think that's something that's really important for businesses who are looking to scale to understand and know. So yeah, so really focusing on obviously your growth rates, but also like your net revenue retention rates are really important, because obviously you want to be growing within your customers, as James mentioned earlier on with the land and expand. You don't want to be signing up customers and then losing them over the next number of months ahead. Your cost of acquisition is critical, and how long they'll likely stay with you, as I mentioned, and then your burn rates and your churn rates. And then look, I wanted to touch on how to engage with these guys, right? So because this is really important, right? Because we often get phone calls from businesses that are really nice and who may have taken on some equity before, but this might be perhaps maybe the first proper, I suppose, interest from a growth equity perspective. into their business. And they often say, how do I manage this process? And look, we've got a few things here. They're just pointers, but I'm not going to run through everything here. But you know, it's all about just really understanding as best you can. Is there chemistry between you guys from early doors? Is there a genuine interest here? You got to be careful about what information you share with some people. So getting a non-disclosure agreement in place, I'm always still a big fan of. I know it's only worth the paper it's written on, but I still feel that it's the start of a partnership, and it signifies that. It should signify something to both parties. Just being polite and professional. Being able to share information with them about your business. The right type of information is really, really important, especially pre-term sheet. Because as I said, you want to have that built up. It's a muscle that you're building here when you're organizing your business and getting ready for these conversations to be had. We're a firm believer that you shouldn't go through this alone, and that you should have someone, guiding you as well. So from a corporate finance perspective, or a legal perspective even, or a tax perspective, there are advisors out there who can really assist businesses. And the reason why I say that in particular is because we've seen so many instances where, they haven't, a founder perhaps maybe hasn't, gone down the road of enlisting the assistance of any advisors, and come, there can be various different terms, and liquidation preferences and things like that are difficult to understand, perhaps maybe for founders, perhaps who especially for him, this might be their first rodeo in this game, but they're brilliant technically, but not perhaps maybe financially. And down the road they can get really, really burnt. In this instance, we've certainly seen it. Due diligence then typically takes anywhere from 1 to 3 or 4 months, whatever. It can take as long as it needs to take, really, if I'm honest. It can be very invasive. And again, having someone there to guide you through the process is really important. And also managing the communications, because like obviously this is what an advisor does day in, day out. Whereas for most founders, especially for first-time founders, this is perhaps maybe their first time scaling a business and taking on equity. So it's really important to get the right people around the table. And then, obviously, you would then need to enter into legal documentation, which, your solicitors and corporate finance advisors can assist on. And then finally, I suppose, look, the really key thing here is, because I'm not going to get into the specifics on legal negotiation, but the really key thing here is you've got to work with these guys post-acquisition or post funding. And so there has to be a good relationship between you guys. If there's not, and if you feel that that's not going to be the case, in my view, it doesn't really matter, within reason. Obviously, how appealing or how enticing a term sheet or a set of legal documentation can look. If you don't feel like you're gonna, if you feel like the marriage isn't gonna work when things get tough, I always advise not to get into it in the first place. So I suppose we're coming towards the end of our presentation here, but I just wanted to kind of give you a sense as to how Vico Advisory can support businesses on both their M&A journey and their scaling journey. So the services we provide is sell side, buy side M&A advisory, financial due diligence, and post deal integration. But we also provide scaling advisory services in conjunction with James, whereby we really assist on businesses, technology and services companies. The more niche, the better. On that scaling journey, both operationally, technically, strategically, and financially. We're sector agnostic, obviously, but these are areas that we've either acquired or managed businesses in over the years, and so we're particularly knowledgeable in these specific areas. But we're always curious to learn more, and keen to hear about new businesses and new opportunities. So I'm going to stop now, and I'm going to enable the chat. So I'm going to host tools here, and I'm going to enable the chat. So guys, I hope you've enjoyed our presentation, and if you've any questions, please feel free to ask them. And just to say as well, like, look, we've given you strategies that separate companies at scale from those that plateau. But look, the best insights do come from your specific challenges. So making it interactive is really important here. So do drop your questions in the chat, and whether it's about funding, timing, team structure, or anything that just keeps you up at night. There's nothing off limits. I was going to ask you, James, just in the meantime, in the period in which you took first derivatives from 1 to 100 million in revenues, without any acquisitive growth, or much anyway, like what were the two or three main takeaways from that experience? Perhaps maybe things that were slightly surprising or things that you might have done differently.
Um, I suppose we tried several things that didn't work, over the years, and having an ability to run experiments and then sort of pull back from them if they're not working, before they become too costly, I think was one that we kind of learned along the way. Some of that is related to geo expansion. So we went into sectors that or geos that just didn't quite work. In other times it was more around the product. You sort of tried to develop, product for industries that we just didn't quite have the right fit for. So sort of designing kind of frameworks that allow you to sort of test these things efficiently, quickly, fail fast is something that you'll hear a lot of, particularly the kind of US colleagues talk about. It's just a great way to get to figure out what's going to work, and as soon as you get to that, you want to double down on it as quickly as you can.
So thanks, James. Yeah, that's really helpful. Um, yeah, there's a question in here from Stephen. So I think I might take this. So my business is generating 3 million ARR and is profitable. How would a potential investor value my company? Thanks, Stephen. Okay, so couple of things in this. So I think the key thing I hope that you're taking away from today is it's really your growth rate at top line, and also how good is that growth, and how good is that revenue. So if you're growing at a kind of 25% top line rate, and if you're nicely profitable at that kind of like anywhere from, 15 to 25% EBITDA margins, like that's, you're onto a real winner there. Like depending on the nature of the business, obviously, there are some sectors that perhaps are maybe more enticing than others, for various different reasons, especially with external influences as well. But generally speaking, like if that's the nature of your business, then I would think that and it depends on the type of investor you're looking for. But an investor coming in, you could be looking at a multiple of revenue, anywhere in that kind of like mid single digit kind of range, wouldn't be amiss here, I think. But I'd certainly need to know a little bit more about your business. So more than happy to take that offline if you'd like to reach out. And then Fanula here, so given the movement towards the more widespread use of AI, and the ability for large businesses to be scaled by a small number of people, how sustainable do you consider that to be in the long term? James, do you want to take that?
Sure. So it's definitely true that you're seeing these days very young companies scaling very, very quickly, and using AI as one of the primary tools to do so. I think that's a trend. It's that'll persist. No doubt about it. You'll be able to scale quicker. However, some of the companies that you've seen do this at like crazily fast speeds. So OpenAI with ChatGPT as an example. I don't expect that type of thing to be the norm. So many companies have scaled to $1 billion valuation like almost overnight. But they're quite often in the consumer space. And maybe they have enterprise offerings, but it's sort of they're really scaling quickly because they've got network effects, and they're onboarding substantial percentages of the population. When you look at sort of enterprise services and tech businesses, um, I think scaling them becomes more effective. Go to market we talked about is more streamlined, and delivery capabilities will be more streamlined as well. But I don't expect it to be quite so quick, steep in terms of the growth curve. But it is it's not a temporary thing. In general, AI is going to accelerate how companies scale.
Thanks, James. And finally, question from here from Chris, which I'll take. From your experience, what's the first red flag that tells you a company isn't ready to scale, even if their numbers look good? I think it's all down to organization. So what I was mentioning earlier on, like even if your figures are looking good, and both internally and externally, in the sense of like even if you're operating within a market that's just going gangbusters, if you're not organized enough, and what I mean by that is if you don't have the right structures in place for, from a people perspective for starters, if you don't have the right systems, the right structures, the right policies and procedures in place, the right repeatable processes in place, it's just your competitors are going to avail of that growing that growing market that you're operating in as opposed to you. So that's one of the key things that we always look for when we're looking at businesses and their ability to scale. So I hope that's been helpful for you, Chris. But before we wrap up, let me leave you with this. Look, the timing, the difference between founders and who build companies at scale and those who don't isn't talent, timing, or even luck. It's one thing. They treat growth like an engineering problem, not like a hope and pray strategy. So your next 6 months will define your next 6 years. So the real question is, are you going to wing it or are you going to engineer it? For those ready to engineer it, we're here to help. You can book a free call, connect with us on LinkedIn, sign up to our newsletter, or just send us your toughest growth challenge. We're also prepared. We've also prepared a series of upcoming masterclasses packed with actionable insights. I'm just going to share my screen again for 2 seconds so that you can actually see them. 2 seconds. Can you see my screen now?
We're still looking at the Q&A slide.
Okay, perfect. The Q&A slide. Gotcha. Okay, thanks. So yeah, so if you want to get your phone out now and do the QR code, you can book a free appointment. You can follow us on LinkedIn. We here are our upcoming masterclasses. So each month we run these, and they're just good to, I suppose, get the conversation started. Like we see this as the start of a partnership with you guys going forward. And our handout will also be sent to you via email later on today. Feel free to use it, share it, or even print it and stick it to the wall. Thank you so much for your time today. Now go build something that scales. See you on the next masterclass, which is on July the 24th. Thanks for your time.